As we move into the second half of 2022, it's clear that the smooth, steady recovery we had hoped for at the beginning of the year isn't going to happen. With inflation at a 40-year high, Russia's war with Ukraine, and China's zero COVID policy disrupting global supply chains and commodity production, we're looking at a list of historic worsts and firsts that have the equity markets on a wild ride.
In response to the uncertainty, we have downgraded our forecast for U.S. economic growth this year to near 1%. The economy actually shrank in the first quarter due to trade issues from ongoing supply chain disruptions in Asia. Auto manufacturers and energy producers continue to struggle to ramp up production and rebuild inventories.
Now, consumer confidence levels have dropped to their lowest in 10 years with record high gasoline and food prices. Consumer spending and the job market have been very strong, but the number one issue for the economy right now is inflation.
Inflation trends have not only moved higher, but the inflationary drivers have broadened out from higher goods prices to include now accelerating wages, rents, services, and commodities. Overall personal incomes have been rising with the strong job market, but inflation is taking a big bite out of consumers' paychecks. Inflation has gone higher and lasted longer than most, including the Fed, thought it would. As a result, the Federal Reserve has gone from a slow and steady approach on raising rates and reducing the size of their balance sheet to trying to figure out how fast to tighten policy without driving our economy into recession. The Fed has no choice but to continue hiking short-term interest rates to slow the economy. While we may have seen the peak rates of inflation, the ongoing supply issues in the labor market, the lack of housing, and basic commodity shortages may persist even as the economy slows.
We started the year expecting 2, maybe 3 interest rate increases by the Fed. By mid-June, the Fed had already raised rates by 150 basis points, and the outlook is for a rate increase at the remaining 4 meetings this year. Those increases could be anywhere from 50 to 75 basis points per meeting, as opposed to the more normal 25 basis point moves. The goal for the Fed would be to raise rates quickly enough and see the economy cool down to allow economic output to catch up with consumer demand, which would allow inflation to slow towards their 2% target. Achieving this goal will be hard because inflation is well above that target.
Core measures of inflation at the CPI level are at 6%. And even the Fed's preferred measure, the Core Personal Consumption Expenditures Index, is close to 5.5%. The question is how much the economy has to slow to bring down these numbers as the job market remains very hot. There are almost 2 open positions per unemployed person in the U.S. today. And global events like the war in Ukraine drive up food and energy costs. Meanwhile, China's pursuit of a zero COVID policy is slowing global output. Fed Chair Jerome Powell has indicated an understanding of the potential difficulties for our economy going forward. From our lens, the longer-term risks are higher if inflation expectations stay high and the Fed has to raise rates more than the market currently expects. His outlook for a quote-unquote softish landing might mean we experience a shallow recession. But if doing so now reduces longer-term inflation expectations going forward, it might be just what the economy needs to avoid an even sharper downturn in the future.
While the Fed still has a long way to go, the financial markets are way ahead of them, with some already pricing in a recession. Mortgage rates have spiked higher by over 2%. Stock prices have fallen, the US dollar has risen, and credit spreads have been widening. All of these factors are tightening financial conditions, raising the cost to borrow, are headwinds to corporate profits, and will eventually lead to slower economic growth and lower inflation levels.
Year to date, bond yields have exploded higher, taking bond prices lower. As rates went up, stock multiples and prices went down. Not only have we had increased volatility in the financial markets, the bond market has had its worst start in some 40 years. Additionally, stocks have been quite volatile and have generated negative return, particularly in technology, an area that has led the market for much of the past decade.
Right now, the market is focused on 4 sources of potential trouble: China's zero COVID policy and its impact on supply chains, Russia's war with Ukraine as both countries are substantial sources of agriculture and energy commodities. Inflation in the Fed may have to continue raising rates to slow demand, possibly triggering a recession as a result. And fourth, earnings in the back half of the year may need to be revised lower as growth slows and margins compress. Now looking forward, markets have a lot to worry about, which is why it's so important to meet with your advisor to make sure your investments are in line with your long-term goals.
So, there's a huge wall of worry, but over time, some of these could clear. For example, China will continue to combat COVID, but the pandemic will eventually run its course. Russia's grip on commodity markets may be loosened as the Western world searches for more secure sources. On inflation and earnings, inflation is already high, and the Fed has begun the fight. We believe earnings estimates for the second half may be too high, but over time, those estimates likely will come down.
Equally important, we would point to the midterm election. Currently, D.C. is controlled by one party. However, with a low presidential approval rating for Biden, we believe it's highly likely the House flips to the Republican side of the ledger. Historically, the market has preferred a divided government, where one party controls the presidency and another controls Congress. This is where market returns have been robust.
The volatility we've seen this summer may continue. However, as clarity comes with regard to COVID in China, Russia and Ukraine, and inflation in the Fed, markets may see some uncertainty decline. Our base case is the economy grows continually, and if that's the case, we expect the current volatility could resolve itself favorably as the year continues.